To give a picture of the activity in a particular account, each transaction must be posted in the company ledger. Think of the ledger as a file drawer with pages. Each page is an account. To make analyzing transactions easier, accountants have developed a tool. It's called a T-account and is nothing more than a simplified ledger page. Account entries are governed by the basic concept of debits and credits. Every account has a debit side on the left and a credit side on the right. Debits increase asset accounts and decrease liability accounts and owner's equity. On the other hand, credits decrease asset accounts and increase liability accounts and owner's equity. Consider, for example, an owner's initial investment, let's say $7,000. The accountant will enter the transaction. The first entry affects the cash account, which is an asset. The transaction increases the company's cash, so it's debited $7,000. On the right side of the equation, owner's equity is also increased, so that account is credited. With these entries, the accounting equation remains in balance.
But if every transaction's different, how do you know when to debit an account and when to credit it?
Simple if you consider the equation. Assets are on the left side.
Okay.
And left is the debit side of any account.
Does that include asset accounts?
Yes, and since assets are on the left side of the equation, they are always increased on the left, or debit side of their accounts. And if you remember that, the rest is logical.
So, on the right side of the equation, you have liabilities and owner's equity.
Would debits increase or decrease them?
Let's see. Debits increase assets, so they decrease the other side of the equation.
And to increase that side?
Well, credits. Credits would increase them.
It's only logical. For example, assume the company purchases supplies. $200 on credit. The supplies account is an asset. Supplies are increased, so debit the account. And on the other side of the equation, we have accounts payable, a liability. It increases also.
So I think you credit it. On the right side, credits increase.
And now the company purchases computer peripherals, including a laser printer and scanner, for $2,500. This increases the equipment account, an asset. And because cash is paid out, it decreases the cash account. The accountant debits the equipment account and credits the cash account. The accounting equation remains in balance, and debits $2,500 equals credits of $2,500. And of course, this company has customers. A project is completed for an important client, and the firm immediately collects $4,200. The cash account is debited $4,200. And on the right side of the equation, a credit entry to the revenue account which increases owner's equity. Ah, the monthly rent comes due. $800. A check is written. The cash account is decreased by the amount of the check.
So credited it.
And since this is an expense, and expenses reduce owner's equity, the account is debited for $800. Notice that the increase in rent expense reduces owner's equity. The owner of the company has personal rent to pay too, along with other living expenses. So there is a withdrawal from the company account, in this case, $1,000. This is not an expense, but it does reduce owner's equity.
Well, let's see. If owner's equity is on the right side of the equation and we want to reduce it, then we have to debit the withdrawal account.
Now, the business needs computers and software. Total cost $5,000. The company pays $1,000 down and signs a note for the remainder.
A note?
A promise to pay later. In this case, $4,000.
This seems, complicated.
Not if you've paid attention, though it does require a compound entry. First, the equipment account, an asset, increases and so is debited $5,000. Cash decreases by $1,000. Credited. And on the liability side of the equation, notes payable.
Increases $4,000. A credit.
Exactly. Ah, so it's time to make a payment on those supplies that were bought on credit. $100.
Let's see. On the liability side, debit the account. That means reduce accounts payable $100. Assets are reduced too, so credit them. That's $100 for the cash account, so the equation balances.
Finally, how about a payment of $300 on a note? How would it be recorded?
Well, that's another liability to be paid on, right?
Uh-huh.
So, reduce notes payable with a debit and cash with a credit.